RMD rules, starting age, penalties, and 401ks. What you should know and why you should care right now on Retiring Today. Hi, I'm Molly Nelson here with Lauren Merkel. He's a certified financial fiduciary, certified financial planner, and a retirement income certified professional. And here's what we are going to talk about today. The RMD age, the impact on your retirement bill, and the rules for annuities, surviving spouses, and penalties. RMD, let's start with the acronym. Lauren, what does it stand for?
It stands for Required Minimum Distribution. And essentially what that means from your pre-tax retirement account, so your 401k plan, as well as your IRA, at a certain age, the IRS is going to mandate you start taking distributions from those accounts, which makes complete sense because when you put money into your pre-tax 401k plan or your tax-deductible IRA, you made an agreement with the IRS that says they will not tax you on that contribution, and it will continue to grow tax deferred. But they said when you take that money out, you will pay taxes at your ordinary income tax bracket. And oh, by the way, even if you don't want to take money out because you never need to use that money, there is an age that they will mandate you take those distributions.
And you said a certain age, and the reason you said a certain age is because this has been a moving target in recent years. So let's take a little walk down a little history lesson of sorts, and let's go back to the first big change of the RMD age, which was the Secure Act in 2020.
Yes, there are many people taking required minimum distributions today that had to start as of age 70 and a half. But that first Secure Act pushed that back to age 72, and then it pushed it back one more time and said at age 73 is the actual date that many people would have to start taking distributions. And then hold on, there's one more. Age 75 is the last age. Based on the year that you were born, people might have to start taking required distributions. So somewhere between 70 and a half to 75 based on your date of birth.
And what I have or found in my research was that begins in 2033, right? The 75. So we know 2033, a little ways away. We could see this RMD age change again, depending on what lawmakers want to do in Washington.
Yeah, most definitely. We have some years left before that time frame. So there's a lot of legislation that does take place on a consistent base with our Congress. We know that. So stay tuned. We could have some additional changes, but that's one of our jobs here. And something that we do for the families and individuals that we serve is we watch that legislation closely each and every year. Not only do we watch it, but then we also can interpret it to apply to apply meaning to the families and individuals, the plans that we do build. Because it's one thing to understand what an RMD is, it's another thing to understand how it actually works within your overall plan, and then strategies that you can build around that legislation to make that legislation work the best that you can based on your plan.
Yeah, and sometimes there are rules in life that you have to follow, right? You have to follow, or you should follow this RMD age. If you don't, there are penalties. We'll get to that in a little bit. So you feel like, okay, I'll sit back, I'll wait till 73, I'll take that. But in this case, there are some things you could do right now before age 73 to maybe lower that RMD, and that can really help your overall retirement.
Yeah, and this is why getting started planning sooner than later is always a good thing, because the more time you have on your side to implement strategies, it can really help you out. And we have a great example to demonstrate how doing some proactive planning can really help. So in our example, we have Paul, and he is not retired yet, but he's age 57, and he has $1 million in his IRA. And Paul's IRA, we're just going to make some assumptions. We're going to say that his IRA grows by a rate of return of 7%, and he doesn't need to use that $1 million because he has a really nice pension and he optimized his Social Security payments. So he's living on pension, Social Security. He's concerned about his health care costs down the road. He plans on living a long time. So he's allowing his $1 million IRA to grow by not taking distributions out. But wait a minute, he hits his retired minimum distribution age, which for Paul is age 75. And by that time he obtains age 75, his $1 million IRA has grown to $3 million, which means his required distribution is going to be about $122,000. So Paul's big surprise, which is a surprise for a lot of people once they get to that time frame, this is why we call the RMD age the tax ticking time bomb, because for Paul, as well as many others, it increased the tax rate that he is in at that time because he has this pension. He can't turn his pension off, doesn't want to anyway. He has his Social Security, doesn't want to turn that off. So he has this base of taxable income, and now he adds another $122,000 to that base. That's going to kick him up into the next tax bracket, and basically that is going to be his tax bracket forever unless his $3 million IRA balance decrease, which decreases his RMD. But if you calculate the $122,000 versus a $3 million balance, that's about 4%. That's about a 4% distribution. So he takes out 4%, his IRA grows more than that, then the next year's required minimum distribution is going to be higher, and they also require a higher percentage as Paul ages as well. So Paul's RMD future is looking bleak because he didn't do anything from 57
just kind of
to 75.
Keep growing. If you had a graph with the tax bill, it would just keep going up and up.
It's just going to keep going up. So that was option A for Paul, but Paul didn't go with option A because he wanted to do some proactive planning. So what Paul did is he engaged in some Roth conversion strategies from age 57 all the way up to age 75. So the Roth conversions he did, he took money from the pre-tax IRA, shifted it over to the Roth IRA, and once that money's in the Roth, it grows tax-free forever. He did have to pay taxes on the amount he converted in the year he converted, but what it did for Paul is it allowed his IRA balance at age 75 not to be $3 million, it was $2 million based on his conversion strategy. And what that does for Paul is it decreases his required distribution all the way down to about $81,000, which is about a $41,000 difference between option A and option B, which Paul ultimately went with. So a couple things there. One is he has more control over how he takes money out of his IRA because he still has a mandate. He has to take 81, but 81 significantly less than the 122 in the option A scenario. So control over his money was really important to Paul. But also now he has a contingent of his retirement money that is invested in the Roth that is growing tax-free forever, which gives him even more control down the road over taking money from his Roth that is tax-free. There's not a required minimum distribution from his Roth, which really significantly decreases his required mandate and, again, gives him more control over when and how he takes his retirement money out.
That was very interesting. If you want to see that again, I've got a great opportunity for you. So Lauren did a great job of explaining it, but I know for me sometimes to see it visually a couple of times is helpful. Our online Journey to Retirement workshop has a very similar example, but this is with a couple, John and Sue, and they use Roth conversions to put actually an extra about 6 figures into their retirement savings. You can sign up for the Journey to Retirement workshop by texting the number that will be on your screen throughout the show, and you can see that again in greater detail. But let's keep talking a little bit about that Roth conversion and the RMDs. When people hear that he's going to have to take out without doing anything, was that about $122,000? They might be wondering where does that number come from? How is that number calculated? Let's talk a little bit about that.
There's an equation that the IRS uses that says they take the prior year ending IRA balance, so 12/31 prior year balance, and then they divide that by their equation. And that equates to about a 4% withdrawal rate at the age of 75. But that equation changes each year, which means the percentage that Paul is mandated to take out increases each year, which makes sense. Basically what the IRS's tax tables are trying to do is have Paul liquidate that IRA, whether he wants to or not, by the time he passes away. So based on average life expectancy, the IRS is going to increase the percentage that he has to take out just so they can derive tax revenue from those distributions. Because again, they've never charged taxes on that money before.
Sure, they're crunching all the numbers. They know you did pay taxes on it. You made that deal. Yeah, I don't want to pay him now, but I will pay him later. So that's how they try to get that tax revenue.
Yeah, that's exactly it. And then also Paul's thinking about his legacy, because whenever he passes away, whatever's left over is going to go to his son and his daughter, and his son and his daughter will have to pay taxes on any remaining balance that's underneath the pre-tax IRA, Whereas the Roth IRA, that Roth money, they do not have to pay taxes on any of the money that's in there. So from Paul's standpoint, he's taking more control over his money. He's saving money on the overall taxes because the Roth conversion strategy he engaged in is paying less taxes on that money than what he would have under option A. And then he's also giving more control and less tax type of inheritance to his son and his daughter based on these strategies for Paul. So for Paul, it's a win-win-win.
We'll continue talking about RMDs and answer a question that we received recently during that online Journey to Retirement workshop next. Welcome back to Retiring Today. It's time for your journey, your questions. This is when we answer questions that we've received recently during our online Journey to Retirement workshop. Here's a question that we got. Can I use a QCD to lower my RMD? Welcome back to Retiring Today. I am Molly Nelson here with Lauren Merkel. And Lauren, you know the answer to this question.
Well, the quick answer is yes, you absolutely can, but there's a couple acronyms there. One RMD.
All right, let's dive into them. Yep.
We know what that is, required minimum distribution, but QCD might be a little bit new to some of the viewers, qualified charitable distribution. So here's how that works. And let's use Paul as an example. And so in Paul's example, at the age of 75, he's mandated to take out a distribution of about $81,000. Now, in his plan, he doesn't want to spend all of that $81,000. Let's just say he needs $60,000 for whatever he's trying to do. He can spend it, reinvest it, gift it to his kids, whatever. The $21,000 that is left over, he decides he wants to give it to charities. So he gives the $21,000 to a qualified charity. The benefit for Paul is that $21,000 he's not taxed on. Like the $60,000 he took out and spent it or gifted, he was taxed on that. The $21,000 that was a gift, he wasn't taxed on. It also goes to suffice the $81,000 RMD that he was required to take out. So the benefits here is one, that the charity benefits because they don't have to pay taxes on that gift. Paul benefits because he didn't have to pay taxes on the $21,000 he didn't want, and he did satisfy his required distribution. So it was a win-win-win for Paul in that scenario. Now in that scenario, Paul waited till 75 to do the qualified charitable distribution, but he didn't have to. As early as 70 and a half, even if your RMD age is 75 like Paul, you can start QCDs. So even though you're not mandated to take out a distribution until later, as long as you're age 70 and a half, you can start that qualified charitable distribution if you want to.
Yeah, so not only can you can start kind of spending down the IRA, and if you start that at 70 and a half, could you see that a lot of times the RMD is lower than at 73 or 75 when it's time? Yeah,
if you're spending down that IRA, because the RMD is based on the prior year end balance. So if your current year end balance is less than the prior year, your RMD certainly could be less. And this can be an effective part of your strategy. Like Paul, he didn't need all of it, so he could gift it, and he could do more from a qualified charitable distribution if he wanted to, but that just worked out well for Paul.
And when you're helping families plan for this, have you found that most churches and nonprofit organizations are qualified charities? Are there any exceptions that would be worth noting?
There's a lot of our families that do gift to a church, and their pre-retirement or pre-70 and a half gifting strategy is just from their checking account, just in the form of cash. They write a check, maybe they do an ACH, but at 70 and a half, if that's you, at 70 and a half, you can switch those distributions over from the IRA. And the way you do that is the check just has to be made payable to your church. And then that check can be sent to you. You can hand it over to the church, or you can have it mailed direct to the church. Just the key is that the check can't be made payable to you. It needs to be made payable to that church. But that is an effective gifting strategy that you can implement starting at 70 and a half and decrease your RMDs, even though those aren't mandated to start until maybe 73 or even 75.
So RMDs for a lot of people, what you've called often a ticking tax time bomb. So what you do is you work with people on strategies to lower their retirement taxes. John and Sue do just that in the online Journey to Retirement workshop. And what you do with them, it's about a 6-figure savings on the retirement tax bill?
Yeah, it's over $100,000 that John and Sue save off their retirement tax bill. And in the online journey, we're just showing you a simple Roth Roth conversion strategy that John and Sue use to create that six-figure savings. So in the online Journey to Retirement workshop, we're not implementing QCDs or tax loss harvesting or a litany of other tax saving strategies. It's just the simple Roth conversion strategy. So if you have a complete tax plan that's built into your overall retirement plan, your potential savings could be significantly greater.
And the online Journey to Retirement workshop isn't just about taxes. John and Sue make a lot of other decisions too about retirement. They actually go on a journey. They start at lifestyle. You see the map on your screen right now, and they head all the way through legacy. And it's a really great way for someone 57 and older to see what's coming, to see the decisions that are coming in retirement, but also to see what they can do right now to put themselves in a better position for retirement.
And that's really what it's about. A lot of people who are looking to retire, they feel like they don't have enough confidence to make these in many cases, permanent decisions. When you turn on your Social Security, you have 12 months to redact that decision, and then it's permanent. When you convert to a Roth, that's a permanent decision. A lot of these decisions are permanent decisions. You want to make sure you get it right. And that's why we say when it comes to your retirement plan, you get one shot to get it right. You want to make sure you do get it right. And that's what people who come to us to build out a retirement plan, that's what they tell us. They want answers to the questions that they have. They want to know what's missing, what have they not thought about, and then they want the information around all of these decisions that they have to make sure they're making the best decisions they can.
Get answers to your retirement questions by signing up for a Journey to Retirement workshop. It's as easy as a text. You can text the word Journey to the number that's on your screen. Sign up for the next workshop that works for you. Then get comfortable, because from the comfort of your couch or wherever you can essentially access Wi-Fi, you can see John and Sue go on a journey, learn a lot of action steps, and really get a little bit closer to making that retirement decision for yourself. We'll continue talking about RMDs next. Welcome back to Retiring Today. We're talking about the rules around RMDs. I'm Molly Nelson here with Lauren Merkel. And Lauren, a lot of times if you read an article about RMDs, so it's this required amount of money you're supposed to take, and if you don't take it, there's a penalty, and no one wants to pay a penalty in retirement.
Not if you don't have to. I mean, one of the biggest concerns of people going to retirement is, do they have enough? And one way to help answer that is not paying unnecessary penalties. The penalties have also changed over the years as well. The penalties used to be really steep, up to the tune of 50% of the required distribution that you didn't take out. So if your required minimum distribution was $10,000, you didn't take it out, you would have to take that out and then also would pay $5,000 as a penalty tax. That penalty has decreased down to 25%, and then in some circumstances, it could be as low as 10%. So a significant decrease in penalties. However, you still don't want to pay even 10 or 25% if you don't have to. So we need to make sure that these RMDs are not a surprise. Not a surprise, and in a plan, you want to make sure that the RMDs are accounted for, so you know this is how much you have to take out. Here's the deadline by which you have to take it out. And again, that does change every year, so it is a moving target, and legislation also increases the movement of that target from time to time. But within the plan, it'll identify what you take out and when.
Something that's changed also in recent years are RMDs for the Roth 401k accounts. Used to be that you had to take an RMD. You didn't pay taxes on it, but you had to take an RMD from those Roth 401ks, but that's changed.
Talk about a surprise. That was a big surprise, because most people are aware that from Roth IRAs, a required minimum distribution doesn't exist. So many people, after they separated service from their employment, would leave their Roth 401k there. And once they hit RMD age, they did not realize they had to take a required distribution even from the Roth 401k. And as you mentioned, you're not taxed on it. You just have to take it out. That law did change a little while back. So you can leave your money underneath an old employer plan, underneath the Roth 401k, and not be mandated to take the distribution. However, the pre-tax money underneath your old employer plan, you still are mandated to take a distribution from. So you want to be really careful, pre-tax, Roth, what those distribution rules are, so you don't have the penalties.
And then the rules around RMDs for surviving spouses and IRAs, these have been a moving target in recent years as well.
Yeah, and they're quite complicated. So if your spouse passes, you want to make sure that you investigate all of your options to make sure you're making the right decision. Let's go back to Paul. Now, in our example, Paul was single, but let's say he was married and his spouse passed away. His spouse was older than Paul. And so Paul had the option, let's say at 57, Paul had the option that he could leave the money underneath his spouse's IRA, an inherited IRA, and then the required minimum distribution would be based on his spouse's age, the spouse's date of birth. Or his option could be to move that money into his IRA, and then his required minimum distribution will be based on his date of birth. So which way you would go would be dependent upon a lot of different factors. What are your cash flow requirements? What other types of investments do you have? What kind of other income do you have coming in? And then what is the age of your deceased spouse? Older, younger than you, because that's going to play into that RMD strategy. Because you might be required to take a distribution once you hit RMD age from the money you move to your account. But if you would have left it underneath your underneath the inherited name based on your deceased spouse's date of birth, you may not have, or vice versa.
I was trying to get to a conclusion there. Like, do you usually then, if it's not money you need right away, is that when you kind of make the determination?
Yeah, if you don't need the money right away, what you want to do is allow that money to continue to grow tax deferred. Maybe you can incorporate some tax planning strategies with that money. And so that decision then will be based on which one's going to require a distribution first. Is it going to be based on leaving it underneath your inherited IRA based on your deceased spouse's age, or is it going to be better for you to move it to your own account, and then the RMD is going to be based on your age? So there's a lot of factors that go into that. The RMD is a big consideration as one of those factors.
And the 10-year rule doesn't apply in this case, right? Because it's a spousal IRA. That's only if you inherit an IRA from someone who's not your spouse, and you have to use it in 10 years?
Yeah, in this case, you inherit it from your spouse, so the 10-year rule does not apply. If you inherit it from somebody and you are not a designated beneficiary, then you have that 10-year rule that you have to have all of that money out within the 10-year period of time. And then sometimes you would be required to take a distribution each year up until that 10th and final year, or other times you're not mandated to take a distribution. You just have to make sure it's all out within that 10th final year. And there's a lot of things that go in to determine which one of those you fall under. So like most of the retirement things we talk about, there's a lot of if-thens.
A lot of rules.
There's a lot of rules, a lot of customization that's necessary, and these rules are constantly changing. But within the plan, and part of the reason that families appreciate our plan so much is we're there monitoring the rule changes, applying it to their particular plan, and then we're leading those conversations. Hey, Mr. and Mrs. Jones, did you realize that this law changed? Here's what it means to you. Here's the strategies that you can incorporate now based on legislative change. And here's the things we don't really have a choice on. We just need to do this. And that makes all of the planning decisions much easier.
Yeah, and that's where the complex can become simple because you apply it to each situation. What was right for your neighbor might not be right for you, but you can narrow it down to this is exactly how the laws impact you or the rules impact you.
Yeah, the customized approach is definitely a better approach. And in the online Journey to Retirement workshop, we show how John and Sue use their customized plan to make their decisions. Now, your plan's different than John and Sue's, but the decisions and the strategies and the concepts could apply to you, and that's the power of the online Journey to Retirement workshop.
You can sign up for that workshop by texting JOURNEY to the number on your screen. This is Retiring Today, and we thank you for watching.